Hello everybody, I decided to make a quick video that compares stock options and restricted stock compensation plans, accounting journal entries. And here's just a snapshot of overall table that I will be using. As for the fun, I would pull up financial reporting. So this is the most recent report from Deere & Company, where you can see that Note 24 actually explain your stock options and restricted stocks that were awarded to employees. And it's interesting how they actually use the wording that you will find in your textbook. So it's like your textbook became alive. Let's take a look first our stock option compensation plans. I decided to do a little timeline that might be very much helpful for the journal entries. So on the date of grant, your employees will receive stock warrants that normally, when they're done as part of the compensation plans, are called stock options. On the date of grant, there's no journal entry required because actually financially, from assets, liabilities, and equity perspective, nothing has changed just yet. Another date that will be very important is the vesting date, because on the between the grant date and the vesting date is the service period. So the employee is required to work over the service period. In this case, it's 2 years on my timeline before the stock options could be exercised. On the date of the grant, we will hire potential and outside consultant that will develop a pricing model, fair market value pricing model, so we can identify what will be the actual fair market price of the option, or the stock rather, at the time of the exercise. So it's a futuristic projection that is pretty hard to do, and that amount will be always given for you in the problem. Now, your goal as an accountant then to gradually amortize that amount that was given to you and expense it through the compensation expense. So for example, in this case, as I said, service period is 2 years. As an example, you were given $100,000 as the pricing for the options. Then at the end of year 1, you will expense $50,000 as your compensation expense, and it will be recorded as paid-in capital stock options. So I said it's an even allocation year by year. So at the end of year 2, right before your vesting period, you will allocate the other $50,000 in your compensation expense. Now, what if finally vesting date has arrived and you have employees who come up to exercise their option? And just for the fun of it, I'm going to go ahead and draw an option. So an option, for example, you can buy the stock price at $30 at the time of the exercise, and every stock option will have an expiration date. So when you come to me, to the company, you will present this option. Almost works as your coupon, okay? So at the time of the exercise, I will have to debit cash, and the amount you calculate will be a number of options multiplied by the stock option price, in this case $30. It's very important because a lot of times in the problems they will throw you off by giving you market price of the stock on that same date. Market price will be $100, but think of it as if I were to give you a $5 Subway coupon where you can buy any sub for $5. It doesn't matter if the sub is $10 at that day, $12, or fancy one with extra toppings. You can still present your $5 coupon. You only pay what the price stated on the coupon. So in this case, it will be $30 per your stock option, and you will debit paid-in capital for the amount of stock options that accumulated year by year, and magically it will actually agree to your compensation expense. So that amount will be debited as well. And then common stock is always issued at par if you have par value, and paid-in capital in excess of par will be a plug-in amount. Okay, so remember please to never use market value of the stock on the exercise date of the option. Okay, what will happen if your stock options expired? So you never exercised maybe some of them or none of them. In this case, you will debit paid-in capital for stock options for the amount that has been accumulated there, and then close it out to paid-in capital expired stock options. So that's your normal, again, equity account that will be set up. Please make a note that no adjustment is made to compensation expense, so we're not reversing anything. And what if employee leaves the company before the vesting date? So when is that? It's during that service period right here. Okay, so I got impatient, I didn't wait for my 2 years, I left before the vesting date. In this case, I will forfeit my options, my stock options. And again, we will debit paid-in capital stock options, and we will then credit compensation expense. This is it for stock options. I would strongly suggest to do a couple of exercises, and clear understanding of the timeline is very much required. What about the restricted stock plans? How are those different from stock option plans? On the date of the grant, you actually will receive, the employees will actually receive actual common stock. Just like under stock options, we will have to estimate what will be, we will use a stock option model to figure out what will be the compensation expense. That amount again will be given to you in the problems, and that amount is recorded as unearned compensation. And I highlighted in bold, it's a contra equity account that you will be using. So normal balance will be a debit. Just like you do under the regular issuance of common stock, those are recorded at par, and paid-in capital will be a plug-in for the remaining amount. Now, over the service period, when the employees are required to work to get to vesting date, what's the actually, I'm kind of going to back up a little bit. What is the implication of why the vesting date is important here? Because you would think the employee already got the stock. Well, their rights as far as what they can do with stock are somewhat limited. They cannot sell or trade stock until the vesting date. So they still kind of, it's almost a nice carrot to entice the employee to keep working for the company for a longer period of time. But over that service period, we will gradually amortize unearned compensation amount and record it as compensation expense. And there will be nothing needed at the vesting date. Okay, so there's no exercise of the option journal entries that we need to make. Rather, if employee leaves before the vesting date right here, then we will have to take off the books the common stock that we recorded and additional paid-in capital. Then compensation expense for the total amount that we recorded up here year by year will have to be credited. And then remaining balance in unearned compensation expense, remaining balance, not the full amount from here, because it will look like a T account where you start with one big debit balance, and then gradually there will be credits for the compensation expense. So you will have remaining balance up here, that's the balance that will have to be credited to take it off from unearned compensation. That's why you will never run into a problem of a gain or loss. So your common stock and paid in capital will magically agree in total to your two credits in compensation expense and unearned compensation. And again, if you take a look at the comparison between the two, you can see how they are alike, yet how they're different. So my hope is that the explanation helped you a little bit to keep them in perspective.